Thanks for joining us. Thanks to the Federalist Society and the American Constitution Society, as well as the funding provided by the Ewing Marion Kauffman Society. Today's debate topic is what exactly caused the financial debacle. One thing that probably we can all agree on as common ground is that the financial crisis, whatever you think caused it, was really, really complicated. And the economic columnist Megan McArdle once said, it's funny how if you get something as complicated a phenomenon as the financial crisis, the conclusion people tend to come to is that it reaffirms whatever they believed before the big complicated phenomenon. But we'll try to avoid those simplistic answers and hopefully learn something tonight. Our debaters will be Peter Schiff and Professor Richard Carnell. Peter Schiff is the founder and CEO of U.S. brokerage firm Euro Pacific Capital, bullion dealer Euro Pacific Precious Metals, mutual fund management firm Euro Pacific Asset Management, and global financial services firm Euro Pacific Bank. He's been interviewed by many media outlets and is known for his radically laissez-faire viewpoint. He's the host of a nationally syndicated radio show, The Peter Schiff Show, and recently took over the time slot of radio pioneer G. Gordon Liddy. Prior to the credit crisis, Peter Schiff tried desperately to warn his colleagues and retail investors of an impending collapse. In 2007, he released the book Crash Proof: How to Profit from the Coming Economic Collapse, which sold over 150,000 copies. A compilation of his appearances, the YouTube mashup Peter Schiff Was Right, has been seen by millions. He has since released 5 more books, including the New York Times bestseller The Real Crash, in which he warns that Washington and Wall Street learned nothing from the financial crisis and are setting the U.S. up for a currency collapse. Professor Carnell specializes in the law of financial institutions and has spent much of his career opposing bailouts. 2008 was a rotten year for him. That's a reminder, by the way, that we won't simply be hearing the view that the market never does anything wrong and bailouts are always wonderful. Both our debaters, fortunately, are more nuanced and far more interesting than that. Professor Carnell served as Assistant Secretary of the Treasury for Financial Institutions from 1993 to 99. He played a key role in developing the Clinton administration's financial modernization proposal. As senior counsel to the U.S. Senate Committee on Banking, Housing, and Urban Affairs, he was architect and principal drafter of the FDIC Improvement Act of 1991, which tightened capital discipline on banks, required risk-based premiums, and ended too-big-to-fail treatment for 17 years. Professor Carnell also spent 2 decades on Fannie Mae's enemies list, and as a consultant to President Bush's Council on Economic Advisors, he helped persuade the Bush administration to demand enactment of workable mechanisms for handling the failure of Fannie Mae, Freddie Mac, and other government-sponsored enterprises. He's co-author of the leading textbook in financial institutions law and holds a BA from Yale University and a JD from Harvard Law School. And now, I'll go in alphabetical order, all 2 of our debaters, and start out by asking the very basic question that is the title of today's debate. Professor Carnell, what exactly was the cause of the financial debacle?
Exactly. Well, I'm going to point in a broad brush way to part of the picture here, and then I want to speak in particular to banking regulation. Certainly the context in which the debacle occurred, and I use the word debacle because we're not just, what's of interest here is not just the crisis of 2008, it's what led up to it, and a combination of the mistakes there and the missed opportunities is part of what it really makes it a truly grand fiasco. So what we see in this decade is large federal budget deficits, loose monetary policy, and think about the consequences of loose monetary policy. Interest rates are lower than they otherwise would be. Low interest rates fuel borrowing, and that drives up asset prices. And in this case, asset prices were driven up to unsustainable levels. Low interest rates also created pressure for money managers to take greater risks than they otherwise would. Risks that they may in fact have felt uncomfortable about. But hey, if you're not going to be giving your investors a pathetic return by the standards that the investors are used to, you got to look and see, well, by intelligently taking more risk, can you get a higher, more respectable looking return? You also, with any sustained economic boom, there is a complacency that sets in. And we saw here, for example, complacency about credit risk. Looking at borrowers from all the way from subprime borrowers up to large corporations through rose-tinted glasses. But let me speak more specifically about banking. Banking was only part of the debacle. It was an eminently avoidable part in most respects. The banking part of the financial debacle was above all a regulatory failure. Bank regulators had every single power they needed to establish and enforce high standards of financial soundness for banks. And if anyone has doubts about that, I encourage you to name a financial soundness problem confronting the banking industry that bank regulators lacked power to deal with. I have been issuing this challenge now for 4 years and have yet to hear a serious exception to that. Have yet to hear an exception to my statement. So regulators could have made banking a bulwark for our financial system, and instead it was a source of weakness. The regulators spent much of the last decade trying to please the industry. In some respects, that was enlightened, getting rid of regulation that doesn't make sense. But there was also a failure to establish strong standards that were necessary in the context of our system. Let me give you one example there. Banks are held to standards of net worth that in bank regulation are called capital standards. So it's basically, but I'll use the term net worth. Net worth is the amount by which your assets exceed your liabilities, and it's the same basically as equity. So we have rules that talk about how much debt banks can take on in relation to their equity. Most people would be surprised to learn that the rules we have even now allow banks to take on $24 in debt for every dollar of their shareholders' money. That's very high leverage. You would not see it in a free market. It is made possible by federal deposit insurance and other governmental support for banks. Now, in practice, banks need more than 4 cents on the dollar of equity. But what we saw during the past decade was commonly about 7 cents on the dollar. So, or put it differently, about $13 in debt for every $1 of equity. Now, this level, which I'm saying in simple form as a 4% level, was set during the 1980s. After that, we had 2 decades of prosperity and record bank profits, and regulators never raised the required level. Now, think about this. In a free market with no deposit insurance, no prospective bailouts, no other government support for banks, what level of net worth would market participants expect? Well, it's going to be a lot more than 7 cents on the dollar. It's probably going to be more than 10 cents on the dollar. that would depend on the bank's business and asset composition. But a point like this sits very poorly with the industry. People want what they're used to. But regulators have a responsibility to be thinking through the answers to fundamental questions like that. If people disagree, I'd be interested to hear that. But the starting point ought to be, what would be required without the prospect of government support for banks? And it's a much higher level than we have now. Unfortunately, the Dodd-Frank Act responded to the regulatory failures of the past decade with a great deal more of the same in the banking area. So giving regulators more powers, in many cases giving them powers they already had, that was pretty cool. And it also trenched too big to fail treatment. And I think it really could end up exacerbating the cycle of boom and bust. So we had a huge fiasco here, and I tend to agree that not much has been learned from it.
All right, well, and so before I ask what exactly caused the financial debacle, the first question I have to ask Peter Schiff is, do you disagree with any of that? It sounded like a lot of what he's saying is that regulators and too big to fail bailout policies and federal deposit insurance and easy money policies were causes, and that sort of sounds like things you said.
Yeah, I mean, you basically took some of the words out of my mouth. I was going to say that I didn't really hear much to disagree with, so it's going to kind of make it hard to debate if I'm agreeing with my opponent. But I can start out disagreeing with the moderator. Because you said something that I disagree with, so maybe I can debate you. Well, you started off by saying that the crisis was complex. I think it was actually very simple. I mean, I'm not that smart. If it was complex, I couldn't have figured it out. It was because it was so simple that to me it was so obvious. And so, I can give you a quick synopsis or my explanation of why we had a financial crisis. The interesting thing is, what I'm about to say, I haven't really changed a word from my explanation back in 05 and 06 as to why we were going to have a financial crisis. And so, I would challenge people who would have an alternative version of what happened to say, well, where were you back then? I mean, if that was the case, then why weren't you able to forecast the crisis? Why does your explanation only work in hindsight? Mine worked in foresight. And the reason that we had a financial crisis, and of course it was inevitable that we would have that crisis, was because of bad monetary policy, bad fiscal policy, and bad regulatory policy. I mean, all three of them had to do with it. And the biggest culprit was the Federal Reserve. The Federal Reserve deliberately brought interest rates down to stimulate the economy. But it really didn't stimulate the economy in that we got more factories, we got more production, we got more output. What the Fed stimulated was consumption, and the vehicle was housing. Because interest rates went down to 1%, it made it very easy for Americans to borrow money to buy houses, and therefore the people selling houses could raise their prices because people bid on houses based on what the monthly payments are. And the lower the payment is, the more you can afford to buy. And so housing prices began to rise. At the same time, though, the banks allowed homeowners to extract the equity. So even if you didn't buy a new house, your house became more valuable. And unlike the stock market bubble, you really were able to borrow out all that appreciation. You didn't have to sell your house like you would sell a stock and then spend the money. You didn't have to sell anything. You could just borrow against the appreciating value of your house and spend money. And a lot of people were doing that. And people thought they were rich. Many Americans acted like they won the lottery because they owned a house. In fact, many Americans stopped working because they didn't need to work. They owned a house. And so people were spending money we didn't have. The trade deficit was going through the roof back then because we were spending all this money on foreign products. Because we didn't, you don't create any products when your house is going up. So we were buying products from China, from Japan, and in exchange we were sending the world our dollars, which the world had nothing to buy because we weren't producing anything. We were just building houses and remodeling houses. But our creditors were taking the dollars and using them to buy mortgage-backed securities, Fannie and Freddie, because they wanted higher yields than treasuries, because the Fed had rates so low, so they took on a little bit more risk, although they thought there was really no risk. They thought that there'd be an implicit guarantee. And so it was a self-perpetuating spiral. The more money we extracted from our homes, the more foreign products we could buy, the more demand for mortgage-backed securities, the lower rates were, and it was just, people thought it was a virtuous circle. As it turns out, and I pointed out, it was a vicious circle. So the Fed kept interest rates down because it wanted people spending money. It wanted to create a recovery, even though what they did do is they prevented a legitimate recovery from taking place. And instead, they gave us a housing bubble. And the reason that people were able to borrow so much money, one was because rates were low. And if you remember back in the housing bubble, the concept of a teaser rate. And what a teaser rate was a temporarily low interest rate that enabled you to buy a house that you couldn't afford. And where did that teaser rate come from? It came from the 1% Fed funds rate. But a lot of banks, normally they would see through this and say, well, look, you got a teaser rate. What happens in 2 or 3 years when the rate goes up? And you can't pay. We're not going to lend you all this money when it's obvious that you're not going to be able to make the payments. Well, Fannie and Freddie were guaranteeing those mortgages anyway. The government was guaranteeing mortgages based only on the ability of the borrower to afford the initial payment. Now, no bank in their right mind would make such a loan without the government guaranteeing it. Once the government guaranteed it, the banks didn't care whether the borrowers could pay back because the government was going to pay. So you had people taking advantage of the artificially low interest rates by the Federal Reserve, and then using the government guarantee to take those low interest rates and qualify to buy houses. And of course, as housing prices were going up, you get that mentality, that bubble mentality that they can only go up. And the higher they go up, the more people want to buy them, yet the Fed is making it easy. In fact, I wrote back in 04 and 05 how paradoxically rising home prices were actually making buying a home cheaper. Because normally if you buy a house, you have to think about the cost of maintenance, insurance, depreciation, taxes, all that. But back in the housing bubble, if you buy a $500,000 house and you expect it to be worth $600,000 a year later, that $100,000 that you can borrow out represents income to you that will defray the cost of owning a home. And so rising home prices actually made home ownership cheap. In fact, people were being paid to own a house. So we had this big bubble. And the banks, of course, weren't really worried about default anyway, because, well, the house would just go up in value. So if you defaulted, well, we'll just sell the house. But nobody could come to the conclusion that all this demand would eventually turn around when all these, adjustable rate mortgages reset. You had a lot of people who were buying houses with no intention of living there. They were going to flip them or try to make a quick profit. You had a lot of speculators in there. But all this was enabled and actually encouraged by the Fed. I remember Alan Greenspan gave a very famous speech in which he praised adjustable rate mortgages at the lows of the interest rate cycle. He basically encouraged people to take out adjustable rate mortgages, said Americans were being sophisticated in managing their home equity, even as they were just spending it into oblivion. And of course, towards the tail end of the market, you had the subprime market, which was not created by the government, because once the housing bubble was really going and the government got it started, Wall Street came in to try to finance the mortgages that even the government wasn't guaranteeing. But the big problem there was, who was the biggest buyer of these subprime mortgages? It was Fannie and Freddie. They actually made the market. Now I'm hearing even that almost 70% of the subprime market was basically underwritten by Freddie and Fannie, but they were in there buying. And of course, without the Fed, there would have been no subprime market, because the key to a subprime loan was that teaser rate. I think the most popular one was a 2 and 28 mortgage, where you had a teaser rate for the first 2 years. And and even the mortgages that were guaranteed by the government, there was so much fraud involved in the origination. Mortgage brokers were actively working with their prospective borrowers to try to falsify their documents, their income, their wages, in order to get a Fannie and Freddie guarantee, because nobody cared. And of course, eventually they had mortgages where you didn't have to bother. You could just lie. You didn't have to state your income or prove that you had a job. You just made it up. But all of this was a function of cheap money, of the moral hazard associated with guaranteed mortgages. And not only was it Fannie and Freddie, but you had the FHA that was out there. actively encouraging people to buy homes they couldn't afford. You had all kinds of sham transactions where the sellers were gifting money to the buyers that they could use as a down payment to overpay for a house. And the buyers, of course, were poor people with no ability to really service the loans. The government created all this. And of course, when the lending standards collapsed as a result of all the cheap money and people were buying houses with nothing down, I mean, of course, why not gamble when, you have none of your own money on the line? And as far as, why were the regulators looking the other way? Because they were told to look the other way. Because nobody wanted to rain on the parade. Everybody wanted this phony economy going. Because the voters were happy. They thought they were rich. They were spending a bunch of money. The politicians were happy. The bankers were making a fortune in the short run. Everybody was making money as our whole economy was, being gutted. But this was obvious to me that it was going to end badly. I knew that eventually the music was going to stop. That real estate prices were going to fall. They would have to, as mortgage rates went up and as speculators were caught holding property that they couldn't unload. I knew that people were going to be walking away from their mortgages when they had no home equity. I knew that many people had borrowed out their home equity, several times over, and that banks were sitting on all this worthless paper that they were carrying on their books as actual assets. I knew if somebody had like a $600,000 mortgage on a house that 3 years ago was worth $300,000, I knew that the paper was going to collapse. And I knew that all the rating agencies, I could see, was obvious that they were rating stuff investment grade or AAA that should have been junk. It should have been obvious, but nobody really cared because of the environment that we're in. But again, this was all what the Fed did to stimulate the economy out of the recession of 2001, 2002, which also was a consequence of bad monetary policy in the 1990s. And the big problem is that when this bubble burst, and the collapse came, and I knew this was coming. I said, banks are going to fail, Fannie and Freddie are going to go bankrupt. I mean, this was obvious to me just intuitively. I didn't even have any window into the bank balance sheets. Right? Just as an observer of what was going on, I knew that these banks would fail. Right? I knew that Fannie and Freddie would go bankrupt just based on the small amount of capital they had and the enormity of the loans that they insured. And I saw how much real estate prices had gone up. I could look at a chart, and I knew if prices would go like this, they can go like that. But nobody believed that. Well, the problem is when this inevitable bubble collapsed, the government, Federal Reserve, acted as if nobody could have seen this coming. It came out of left field. This is a 100-year flood, right? Having nothing to do with our bad policies. And what was their conclusion? That we need more regulation. We had too much capitalism, too much greed, without any idea of how it happened. Like, George Bush said that Wall Street got drunk. And I said, yeah, they were drunk and Main Street was drunk, but they didn't bother to try to figure out where the alcohol came from, why they got drunk, figure out that Alan Greenspan was the bartender. Instead, they gave the Fed more power, to liquor the country up with even more cheap money. Because I think that the crisis that's coming, that's the subject of my most recent book, The Real Crash, the crisis that's going to come as a result of this most recent round of stimulus that isn't even over, unfortunately, because now they're about to launch QE3. But this crisis is going to be worse. The bubble that we have in the government, in the bond market, in the dollar, when that bursts, and when we have a sovereign debt crisis and a currency crisis, similar to what's going on in Europe, but only on a bigger scale, when we have that, I mean, then that's the end of the game. There's no way to postpone the pain anymore. We're going to have to live through it, and unfortunately, it's going to be excruciating because of the lengths that the Fed has gone to postpone it.
And on that grim note, let's see, Professor Carnell, do you agree with all that? And if you do, I'll explore some more contentious areas, but it was basically a Fed-induced housing bubble.
I think the Fed was a major influence, and I do think I would sharply criticize this as we have here. But I think we also need to, and you rightly mentioned the trade deficit. The trade deficit, by the way, had a not only were we spending money we didn't have, but the money was going to other countries that were holding on to it and reinvesting it in this country. So, for example, the government of China took China's trade surpluses.
But they were investing it in mortgages and in treasuries. They were, it wasn't that they were building factories over here.
Yes, I'm not. And the point I wanted to make was normally you'd think people are investing in our country, that's good. And but the consequence of all that capital being available to invest was to further keep interest rates low. So we could be on a borrowing binge without this demand factor raising the price.
Yeah, I would say it wasn't invested, it was malinvested. It went into the wrong parts of the economy.
That's a fair point.
It fed consumption, it fed housing. We obviously didn't need more housing. We were overhoused, and we have a glut of houses now. What we needed were more factories, more production to shrink that trade deficit. But we didn't get that. If the Fed had let interest rates rise in 2001, 2002, instead of pushing them down, we would have had a more severe recession, but we would have corrected some of those imbalances, and we would be a far healthier economy today. We would have avoided the housing bubble and the financial crisis, but for political reasons, the Bush administration, the Fed, did not want to allow a necessary but painful restructuring of the economy, so they screwed it up even more by compounding the mistakes with a housing bubble that exacerbated everything. I mean, if you thought that trade deficits were bad, in the 1990s, I mean, they went off the charts during the 2000s, and look where they are now. I mean, we're still running trade deficits of $500 billion a year.
Were there regulatory fixes?
I wonder, though, if I could respond to Peter here on 2 points. The first will be an agreement point, if I remember correctly, and then the other a disagreement. The first thing I want to emphasize is to pick up on Peter's reference to corrections. There is, and to put it in context, there is something about human nature that makes most of us want to buy during a boom and to be tempted to sell during a bust. So that is, there is something in most people that pushes us toward buying high and selling low. And if you really want to buy low, sell high, you've got to discipline yourself to do something that goes against the herd mentality that seems to come naturally to us. So so booms and busts, I think, are built into human nature. And in any event, we see them repeatedly in economic history. And so part of what you've got to have is a correction. That is, when you have a bust, in order to have a healthy economy going forward, you've got to have the dead wood needs to get burned up. Instead, the political dynamics for a while now have sort of been on the notion, well, we shouldn't have pain. It's the government's fault if we ever have pain. I mean, the government has plenty of faults, but the fact is that there are going to be up times, there are going to be down times, and if you try to avoid the down times, you're asking for more trouble in the future. Here's an analogy. If you went back to the 1930s, 40s, 50s, and 60s, you had the character Smokey Bear. I don't know how many of you, but I suspect that a fair number of you missed out on Smokey the Bear, but Smokey the Bear was a symbol of our national efforts to prevent forest fires. And Smokey would stand there with his shovel upright, with sort of a ranger's hat, and say, only you can prevent forest fires. Except for those of us who grew up in the South, it was only you can prevent forest fires in the South. Like maybe those would be the ones that we cared about. Anyway, here's the analogy. The Smokey Bear was a symbol of what we could call fire suppression policies. That is, that forest fires were bad, so we wanted to prevent them. So the upshot of decades of fire suppression was that the amount of incendiary or burnable biomass in forests increased tenfold to what it was before. So that whereas before you would have had a dangerous and unpleasant malaise, after all these decades of fire suppression, you face a conflagration that was truly destructive. Similarly, in an economy and in a financial system, if you don't have corrections, the problems, the dead wood ready to burn builds up. Booms and busts are a natural part of economic life. I think it is right for public policy to seek to mitigate booms and busts through intelligent, responsible monetary policy, tightening when things are heading up, loosening when things are heading down, the Federal Reserve being there to stand as to serve as an emergency lender during troubled times to healthy banks who need to turn assets into cash.
I think that probably says something I can disagree with. I agree with what you're saying about the forest fires, and that was a great example of Alan Greenspan throughout his entire tenure, particularly the 1990s. Every time something went wrong, the Fed came to the rescue with more cheap money. And so we never really solved the problem. We papered them over, and we just compounded them with bigger problems. But
and we got addicted to having Uncle Greenspan come in and bail us out when we found ourselves without enough cash to pay our bills.
So it was actually called affectionately on Wall Street the Greenspan put, and now there is a Bernanke put. But I disagree that that you have these booms and busts historically just randomly, that people just act irrationally for no reason. I think that most of these periods are a response to the bad and false signals that are sent to the economy by interest rates being artificially low. I think when central banks interfere and price fix the price of money, right? In a free economy, prices need to be set by supply and demand. The market needs to discover the price to clear the market and have an efficient allocation. But when the government short-circuits that market mechanism and just picks an interest rate out of thin air, regardless of where the market would put it, and in fact, generally, there is a political incentive for rates to be lower, not higher than they otherwise would be. There are a lot of factions in the country that benefit from cheap money, particularly debtors, because debtors always want inflation, they want low interest rates. The government is, of course, the world's biggest debtor, but American voters have mortgage loans, car loans, student loans, credit card debt. So you have more Americans in debt than who have money in CDs, and so they always want cheap money. Wall Street, of course, wants cheap money so it can speculate, and the lower the cost of money, the easier it is to speculate. And so there's a lot of political forces. So when the Fed puts interest rates too low, and now you got the price of money wrong, and now you have activity that wouldn't happen otherwise. You have too much borrowing because it's cheap. You don't have enough savings because there's not enough return on savings. We consume too much because we have that cheap money. We don't produce enough, we don't save enough. You get these big imbalances that go into your economy. You get a service sector economy like we have, because if you can just import things with your cheap money, you don't need to make them. You don't need those factories with those smokestacks and all the pollution. Just have a storefront with a cash register and let the Chinese get all the pollution. So we get this screwed up economy, and all of this is the fault of this manipulation. And to say that, well, we should put the Fed in charge of somehow mitigating the booms and busts, we should have them tinker around with interest rates. If they think the economy is weak, they should cut rates. If they think it's strong, we can raise rates. They're not smart enough to figure out how to do that. They're more likely to make a mistake and cause the problems that you want to put them in charge of. I think that the best thing that you can do is take the power away from government. Don't let government set interest rates. Let interest rates be determined by market forces, just like the price of everything else. And have sound money. You be on a gold standard. You don't let the government try to guess what the money supply should be, and don't let the government monetize government debt. And I think even if you look back at the various panics or booms and busts that we had in the 19th century, I think they're small compared to what we've experienced in the 20th century and the 21st century, and what we're going to experience. I think this next crisis is going to dwarf even the Great Depression. So I think we were much better off with sound money, and we didn't have those huge misallocations that we have now. And sure, yeah, there's always going to be people will get crazy about certain things, whether it was the railroads or the dot-coms, but these bubbles would never grow as big as they did without the cheap money that financed them. And you know, if the Fed just let people lose money, people would learn their lesson. I mean, how quickly could we have really gone from a stock market bubble to a real estate bubble if the Fed had stayed out and not bailed people out and let the economy heal? We wouldn't have happened. I mean, it's the Fed that numbs the pain. And so, you know, it's like you strain your ankle, and instead of fixing it, you shoot yourself up with some kind of chemical so you don't feel it, and you can keep walking on it, but then, you know, then you break it worse because, you know, the Novocaine sent a false signal to your brain that your foot was fine, so you kept walking on it, when what you needed to do was, you know, get off your foot. So we've got all these problems in our economy, and the free market is trying to fix them, trying to get resources properly allocated, bring up our savings and investment, bring down our consumption, bring down our trade deficit, shrink our government, and you have the federal government, the Federal Reserve, fighting the market, trying to stop that, because in the short run, it's a painful process that none of the politicians have the stomach for. But in the long run, they're not going to spare us the pain. They're just going to make it that much more excruciating.
I certainly agree about the importance of market discipline and the importance of a meaningful adjustment process. I do want to respond, if I may, though, to what Peter was saying, for example, regarding the 19th century. Let me just say before that I don't see anybody credible economically believing the Fed can set long-term interest rates. I mean, what we're talking about with monetary policy would be that the Fed can influence, to some degree, short-term interest rates.
Although right now their policy, stated policy, is to bring down long-term rates, and that's why they're buying all these treasuries.
Yeah, and like I said, a credible view. But I just want to be sure everybody's clear on what the world looked like before the Federal Reserve. And my point is not to write a brief for the Federal Reserve, but be sure that those listening can better form a judgment about sort of what the choices are here. The United States had no central bank from 1836 until 1913. Andrew Jackson destroyed the central bank that we had in the 1830s. And we had financial panics in 1836, 1857, 1873, and 1907. And so this was without a governmental role seeking to set or moderate interest rates. On top of that, and even more frequently, we had real estate booms and busts. I mean, if you look at the big picture of American financial history, the greatest pitfall that banks have faced has been real estate lending. Because let's say if real estate prices double, a bank makes a loan, and the borrower puts a 40% down payment down, and the bank figures, wow, we're really being prudent. We got 40% down payment, and prices go down where they were, and the bank gets clobbered. And there are specific, we could go into this later if people are interested, but there are particular reasons why banks are fragile. They're really fragile because they operate to a large extent on borrowed money. Their liabilities can go out the door in the next hour, whereas their assets are not so readily marketable. And there are other reasons too. So banks have repeatedly gotten burned making bad real estate loans, and this in an era where there was no government involvement in this.
So, but it's hard to argue that I think that the real estate losses under the Fed and under the guaranteed bank deposit model and government insured are much larger. In fact, and we haven't even felt the pain because almost every mortgage in this country is now guaranteed by the U.S. government. And so the unfunded liabilities are enormous that taxpayers face. But I would say that if you compare U.S. history prior to the Federal Reserve, look at the 19th century and compare it to the 20th century, the economy performed much better during that time period. Certainly our money performed better. If you look at prices, prices in 1900 were about half of what they were in 1800. So money gained value. Since we've had the Fed, the dollar has lost like 98% of its value. I mean, look, the Fed has destroyed almost all the value that the dollar had. Before we had a Fed, the dollar was a storehouse of value. In fact, it gained value over time because purchasing power of the dollar went up. But when we had gold, it's gone down since the Fed has been in charge and it's been paper. And I think if you look at the wealth that was created, the rise in living standards, I mean, think about what we went through, the Industrial Revolution, all these immigrants coming into America from Europe. We absorbed those immigrants. We migrated our people from the farms to the cities. We created all these jobs. We created all this wealth without a central bank, without inflation. We created the middle class. I mean, people were coming to America from all around the world because of the wealth that was being created here without a Federal Reserve. In fact, I point out sometimes when I talk, people don't even understand this, but you think there's a lot of wealthy people around right now. Well, of the 30 wealthiest Americans who have ever lived, adjusted for inflation, only 3 of them were born after the Civil War. And only 1 of them was born after the Second World War. So a lot of wealth was created, but not just at the top. I mean, we created a living standard that was the envy of the world. I mean, the middle class was born out of American capitalism, out of a banking system that did not have a government involvement. The biggest problem in the banks is that they've socialized it, is that the government insures all the deposits, and so now nobody in America cares what banks do with their money because the government covers it. The banks know that you don't give a damn what they do with your money. And so everybody speculates, and we've turned over market regulation to the government. When we had none of this, people were very prudent about where they put their money. And banks competed with one another based on soundness. You didn't have this 6% capital. Nobody would put money in a bank that was levered up like that. I mean, but people do it now. I mean, I got plenty of money in Bank of America, even though I think they're insolvent. Why am I putting my money into a bank that I think is insolvent? Because the government told me that they got it covered. If it wasn't for that guarantee, I would put my money in a solvent bank. But now look at the moral hazard, because now that smaller solvent bank loses a deposit that it should have. And instead, the government directs my money into a bank that's broke.
Well, the government isn't directing it, but people are responding rationally to the incentives created by government guarantees. I certainly there's a difference between directing, which suggests a 5-year plan or something.
And distinction without it.
Anyway, I want to get into some distinctions myself. Certainly, market discipline is important, and it has been a terrible mistake to see market discipline on the banking industry impaired to the degree that it has become. And people should be clear that there has been significant additional impairment over the last 10 or 15 years. If you went back and looked after the 1991 legislation that pushed back on too big to fail, you saw the difference in the interest rates that banks had to pay widen according to the credit quality of the bank. It was possible to have more differentiation like that. And by the way, I believe it's possible to handle the failure of a big bank. You've got to have the system ready for it, and you've got to have the will to have the unpleasantness of that occurring. And there's a lot of political reasons why.
And you've got to let some depositors lose money, because right now, whenever a bank fails, they cover everybody. They cover the people whose accounts even exceed the
yeah, that's implicit in my statement about bank failure is that insofar as they were uninsured, depositors would lose money. And basically, the orthodoxy represented by people like Secretary Geithner is that civilized countries don't, indeed can't allow a large bank to fail, that it would be too destructive. And I don't agree with that.
And so they get larger and larger because everybody puts their money in those banks that are already too big.
They get larger and larger, and they also become more and more unsafe.
Yes, exactly.
Now, but something I do want to, you in your eloquent statement a few minutes ago, were conflating some things that are of a different kind. You, in effect, to be a little rhetorical about it, you seem to be blaming the Federal Reserve for the fact that the United States was no longer a developing country. I mean, part of what, this was a developing country during the 19th century, and we had the high growth rates, the sharp increases in living standards that are more possible in a developing economy where you're operating you're growing from a lower base than they are when the base has risen.
I don't think that countries have to stop developing. I mean, there's more things
not.
that we all want. We want to improve our standard of living. We don't want to, think that it's plateaued.
Well, do you think that a 15% or 10% GDP growth is a realistic goal for this country?
Well, I don't know. You
look at the 19th century rates, and it is in a healthy, developing economy. Those sorts of things are realistic in a way that they're not in a developing economy.
It would be very interesting to see the types of growth rates that we would be capable of if we still had the government, the regulatory environment of the 19th century today. Because I know that if we had today's regulatory environment back then, we never would have grown at all. Right, we'd still be an emerging market, but because we had so much freedom and capitalism flourished, we were able to achieve so much. The problem was once we became successful, we basically were our own worst enemy, and we abandoned all the principles that made us rich because of politics, because people wanted to get elected. All of a sudden, you have wealthy people, and you have people who aren't as wealthy, and now the politicians play into that envy and greed, and they try to buy the votes of the masses by promising to tax the wealthy, and they end up killing the goose that laid the golden egg. But they create an economy that is no longer capable of growing because the government has created so many obstacles to growth that didn't exist before. And so we don't know, maybe we could still grow. Who knows? I mean, I think had we maintained our level of government and freedom throughout the 20th century, we would have a very different country. I mean, our standard of living would be so much higher. I mean, we would barely be working by now, probably. Maybe you'd work 2 days a week. Not that many. I mean, probably most married women with kids would not be working. I mean, a lot of men would not be working. We'd have machines doing a lot of things for us. But unfortunately, all that progress was slowed down by bureaucrats and red tape, and so we don't know.
So I love the idea of the trees growing to the sky here, and I certainly there have certainly significant costs to inappropriate government regulation. At the same time, for example, if you look at the late 19th century, you have what economists call the long recession, a recession of 2 decades during a time when we were on the gold standard and we had no central bank.
I think we had a 20-year recession.
It's pretty good. Look up long recession. It was long and it was painful. And look as well at the Panic of 1907, which was apart from the Great Depression, the most severe financial panic.
Right. Well, but the Great Depression was the worst at that point, and that was the only one that had the Fed, and that was fought with a full Keynesian arsenal of stimulus and pump priming. So the corrections that we had absent the Fed were not as bad as what we had with the Fed. And as I said earlier, what is coming is going to be worse than the Great Depression. No American will ever have lived through the type of economic decline that we are headed for, as a consequence of all these government policies.
We got the Fed because of a considered response on the part of opinion leaders and the general public to the Panic of 1907. In the end, you had part of quelling this nation. So you have a panic in which, a financial panic in which the banks of this country for 6 weeks would not allow you to withdraw your money, and broker overnight loans went to an annual rate of 100% if you could get them at all. And so there was people made a considered decision that we did need a central bank.
Well, first of all, we did a lot of stupid things in 1913. We passed the income tax. But, yeah.
1916.
1916, yeah, all right. Well, that's right.
That was good.
Huh?
And I want to speak up for it.
No, it wasn't 1913. It was the same year we got the Federal Reserve and the income tax.
I believe it was
1916.
It may have been.
It was the 16th Amendment, but I'm pretty sure it was 1913. But in any event, even if you say, hey, the Fed was a good idea, the Fed that they created in 1913 bears no resemblance to what we got today, because that Federal Reserve, number one, was not even allowed to have as part of its collateral government bonds. They couldn't buy treasuries, so they were smart enough not to let the Fed buy treasuries. Federal Reserve notes had to be backed 100% by commercial paper and 40% by gold. So it was a very different animal that they were creating. Back in 1913, had anybody proposed creating anything similar to what we have today, it never would have seen the light of day. In fact, they would have laughed the guy out of the country if he tried to come up with something as crazy as what we now have. So it was an example of the camel's nose getting under the tent. There were some good things, and I wrote in my book that had I been around back then, I might have actually supported the Federal Reserve Act the way it was intended. But in hindsight, knowing what happened, you have to oppose it because you cannot trust the government. That is the problem. Once you create a mechanism for that central bank, you create that corruption. And in fact, it didn't take until the First World War, when the government wanted to finance the war by printing money, that they went and amended the Federal Reserve Act. And that's when they gave the Federal Reserve the power to buy treasuries. And in fact, that's when we got the debt limit. You know, we all talk about the debt limit now. We had no national debt limit until we gave the Federal Reserve the power to buy bonds. People were saying, wait a minute, this could be very dangerous. The government could run up a lot of debt. We better put a ceiling on how much debt the government can have. But the problem is, the ceiling was raised. They put a ceiling that they can always raise, but at least they saw the inherent problem in allowing a central bank to monetize the debt of the government. But now, you know, look at the mess. We've got 16 trillion and counting of debt, and we're heading for a sovereign debt crisis because we have this central bank.
So the radical laissez-faire person might say, Professor Carnell, that the two-part solution is abolish the Federal Reserve, or at least abolish it as we know it, and go to a gold standard. And would you say those are crazy suggestions? And what are your big alternate fixes for our problems?
Well, I've noticed that we have been on essentially the monetary one for quite a while, and so this is now still a monetary question. The gold standard has its appeal. There is something to be. There are incentives that public officials have to avoid pain and essentially to enjoy ourselves now at a way that will cost us later. But I would defer to macroeconomists in terms of whether it would, on balance, be healthy to return to a gold standard. I take a different view than Peter does of the history during the 19th century. I mean, there certainly was a perception people at the time of wrenching financial pain, and there is this. In addition, if you do not have a lender capable of meeting banks' need for cash during a financial crisis, financial downturns will be much more painful than the other ones would be.
I Googled it just the 16th Amendment was ratified February 3rd, 1913.
Okay, I stand corrected.
I want to make sure I was recollecting it correctly.
Oh, and if you want to get off the...
we're almost at the 100-year anniversary.
But I do appreciate it. As I mentioned earlier, banks have liabilities that in economic terms are very liquid. That is, banks, in a way you could think of banks are in the business of making 5-year loans with your checking deposits. So it is a tough business in the sense that your checking deposits and lots of other people's could go out the door before we finish this program. And so if banks are going to invest in more than 6-month treasury bills, they are going to need to have a way of being able to meet depositors' needs for withdrawal.
They're able to do that, though. They were always able to do that, and there was a distinction between a time deposit and a demand deposit. I mean, people would know that if they want checkable, immediate access to their funds, that they're not going to get any interest. That if you want to get interest on your account, you need to give the money to a bank for a long enough period of time to generate interest. And so there was a difference between a savings account and a checking account, and the banks would market them that way. In fact, if you wanted a checking account, they charged you money. They charged you per month, they charged you per check, because they were just providing a service. It was a savings account where they paid you because they had access to your money, and it was tied up for a period of time.
Peter, even in a Norman Rockwell banking system, banks are still intrinsically vulnerable
Why?
to runs.
But no.
It is the nature of banking.
I don't think so.
Banks, well, you're jumping in on me more than I'm jumping on you. And you are a radio programmer, and you did not grow up in the Deep South. So you are both quicker and more coherent than most of us bookish individuals who went through our entire childhood being told that we spoke too quickly. I can't understand you, sir. Why can't you slow down?
Well, actually, I'd like to encourage you to finish that point, and then furthermore, feel free to
we
go
can
on.
go on to some other time.
Explain what you think the big fix is.
But the banking business that you see going back for centuries is this, that banks are using money that they may need to pay back right away. And actually, I'll focus on banking over the last 2 centuries. We'll leave out the goldsmiths of Venice or something like that. Banks use money that could be withdrawn tomorrow or that could be withdrawn in a short time to make loans and other investments that have a longer life. And it's the loans that are particularly significant here. They're making loans is on the asset side of banks the most characteristic function. And it's also part of adding enormous value to society. And in fact, this ability to use checking accounts and, for that matter, savings accounts, a passbook savings account, the bank has a legal right to require notice before you can withdraw, but no bank does it. It would be like waving a white flag and saying, "We are losers over here. Give us notice." This is nothing post Federal Reserve, and there is good reason to think that this function of banks, which I'm oversimplifying as saying using your checking deposits to make 5-year loans, that this is very beneficial socially. It makes let's say credit to small business more available than if banks felt constrained only to invest in very short-term treasury securities. Now, there's no the central bank function that I'm referring to here is serving as a lender of last resort. That is, making loans on good collateral to healthy banks. That's the classically understood lender of last resort function of the central bank. And I believe that adds value and is not something.
I think it subtracts value and makes the system inherently less stable, prone to bigger disasters, as we're going to see. See, I just don't buy the idea that there's something inherently different about banks, that the free market doesn't work for banks, that somehow the government has to come in and fix what the free market gets wrong. I believe that competition among banks for reputation, for soundness, will result in a reserve requirement that works in a certain amount of money that is kept in reserve, loans that are made in ways that that work for the free market. And that's when you get a banking system that really loans to entrepreneurs, to businesses, that improve our living standards. Right now, under this system, all the bank loans are going to the government. The banks are loaded up on treasuries. They buy government-guaranteed mortgages or guaranteed student loans, or none of this is helping the economy. It's all suffocating the economy.
And speaking of students, let's see what some people in the audience have to say about this. Do we have questions for either of the speakers? Let's see hands if anyone would like to ask a question. How about you, sir, in the blue shirt right in the front there, and tell us who your question is directed to.
Professor Carnell, I think you made a mistake about when people were pushing for the Fed.
Wait for the mic and we'll get it.
We're pushing for it for about 17 years. The bankers were pushing for the Fed. Were pushing for it for 17 years. 1896 to 1950. In addition, you had mentioned about the recessions that took place in the 19th century. The point I would like to bring up is that sometimes banks issued more notes than they had gold to back it up.
Sure, well, I quite agree with that, and I am quite willing to accept that banks were seeking a central bank before the panic of 1907. But this was a classic example. We see many cases like this in American history where a crisis or a scandal brings about something that had been proposed before, but did not have sufficient support for enactment at this point. And certainly we saw before the Civil War, in particular, we saw during the period with no central bank and no federal banking presence, a pattern of overissuance of paper money by banks. Up until the 1830s, the Bank of the United States discouraged private banks from overissuing paper money because it would, the Bank of the United States itself would go and say, give us gold for this money. So that discouraged overissuance, because if a bank could not redeem its paper money in gold, it faced closure right then. But from there, and then with the Civil War, we get the national banking system. National banks were required to back their paper money 100% with treasury securities. And consumers found that a much more attractive means of payment than the old banknotes of the kind you're describing. So, I take your points. There was.
I think of all the bad laws that were passed after our financial crisis, or after September 11th. Think about the Patriot Act and all the things they were able to do because the political climate had changed. The winds were now blowing in a favorable direction, and it enabled the government to take advantage of a crisis to usurp more power and deprive Americans of more rights.
People, Peter, people can take advantage of crises and scandals from all sorts of different directions, and politicians of all ideological stripes can exploit crises, including 9/11.
Another question, let's see. How about you with the red hair in the second to last row there?
Hi, I have a question for Mr. Schiff. You've talked a lot about basically the Fed today, but I haven't heard anything about the Community Reinvestment Act or about the mandates that were actually passed down from government. Perhaps maybe you could talk to us a little bit about how banks were actually being pushed. They were given quotas of subprime mortgages that they had to give out. They had to demonstrate that they were giving to minorities, giving to low income, giving to people who couldn't provide a down payment. They were actually, given mandates that they had to.
I basically alluded to that when I talked about Fannie and Freddie, which were government-created entities, and when I talked about the FHA and the programs they had with basically financing 0% down mortgages. But you are correct, I didn't mention all the ways the government interfered, and the Community Reinvestment Act was one of them, where the government, for political reasons, pushed banks to make loans that otherwise would not have been made because they were bad business decisions. I mean, the banks weren't discriminating. The banks aren't a bunch of racists. They don't know the color of the borrower. They're just looking at the numbers. They want to make loans. They don't want to turn down the loan. But if they look at the numbers and it doesn't work, if it's too risky, they didn't make it. There was a reason that a lot of minorities weren't getting these loans. It was because they couldn't pay them back. They couldn't afford the houses. But for political reasons, and especially as housing prices were rising because of the cheap money and subsidized mortgages, it appeared as if the only thing you needed in America to get rich was to own a home. And therefore, why should only the middle class and the rich be able to get rich for nothing? Why can't the poor just own a house and get rich for doing nothing? So it became like, it's like the realtors were able to redefine the American dream as home ownership. See, the American dream used to be that anybody can succeed no matter how hard they work, no matter how humble your beginnings. You didn't have to be born into a wealthy family. Your lot in life was not determined by who your parents were. You could be whatever you could be based on your own hard work and your own ingenuity. But all of a sudden, the American dream became owning a home. Why? Because if you bought a home, you got rich that way. And so a lot of people wanted to own homes, and so politicians wanted to make it so that everybody can get on that gravy train. But again, this is why you cannot trust governments to regulate anything. Because if you put the government in charge of the banks, even if it starts out with a noble purpose, right, it's not going to stay that way because the political pressures are going to be there. And that's why we had those bills, because there were a lot of votes to be had by people who are now going to be able to buy a house and get rich, whereas this bank wasn't letting them do it. And that's why you talk about all the regulators. The regulators, no matter how many regulators we had, they were not going to rain on this parade. In fact, the executive at Fannie Mae, I forget the guy's name, but I actually saw an interview with him on CNBC, and this is way after the peak, and he said that they were going to reassess their lending standards at Fannie and Freddie, and they were no longer going to guarantee loans that they knew couldn't be repaid. That they weren't going to just look at the teaser rate; they were going to look at the resets. And he said the reason that we did not do this earlier, the reason we were guaranteeing mortgages, even though it was obvious that the borrower couldn't afford the payment, is that we didn't want to hurt the real estate market. We didn't want to interfere with speculation. They said people were getting rich buying houses they couldn't afford, and it wasn't up to the Fannie Mae to put an end to that.
And yet,
and so they perpetuated it.
I think Professor Carnell has an objection to.
Yes, I would note, Peter, that you very eloquently are stringing together a number of different things, you didn't work the Fed to that one, but a fair number of other things. Now, I want to go back to the Community Reinvestment Act and the issue of the question about whether the government coerced financial institutions to make bad loans. I have been looking among my papers here because I brought a copy of the Community Reinvestment Act with me, anticipating that this might come up, and somehow it seems to have gotten mislaid. So I'm going to pass it down to Peter and ask him.
Now you can just say it says whatever you want.
Yeah. But anyway, the no lender was forced to make an unsound loan. The Community Reinvestment Act doesn't have teeth, hardly speaking. It has gums, but it basically
So can I interrupt there? I know I'm doing a Peter Schiff now by interrupting, but I mean, didn't it affect banks' rating and mean that they couldn't do mergers, they couldn't have a lot of the privileges if they didn't get a high enough rating, if they didn't show that they were, investing in minorities, giving mortgages to minorities? Is it that teeth in a sense?
The Community Reinvestment Act has two provisions. The first says that Congress says that regulators must evaluate an FDIC-insured bank's record of making loans to its entire community. The second provision says that regulators must consider the rating when evaluating applications by the banks to engage in things like mergers and acquisitions. Now, almost never has any regulatory application been denied on community reinvestment grounds. There was a few instances of this in the late 80s and early 1990s. But the bank regulators are not, none of them have enthusiasm for the community reinvestment.
But the whole goal of the act,
wait,
right?
Please, Peter, you're quicker than I am. I'm sorry that
You paused. I thought I had an opportunity.
We are, us warm-blooded mammals. We need to have some intake of air. But I like your enthusiasm. Beyond that, both the statute and the regulations for the Community Reinvestment Act are talking about making sound loans. So there's no push to make unsound loans. There are no quotas that say everybody has to do it. Beyond that, there is nothing that ties where the CRA was pushing for subprime, unsound subprime lending. Now let me just underscore that point, and this was something that I was wanting to talk about earlier with Peter. And that is that much of the subprime market was fully private. Most subprime loans were not originated by FDIC-insured depository institutions that were subject to the Community Reinvestment Act. If you look at the top 25 subprime lenders, only one, as I recall, was an FDIC-insured depository institution. Subprime loans were originated predominantly by mortgage companies. Of course, Fannie and Freddie played a role in securitizing them, but a lot of it was also done in fully private deals by Wall Street firms.
But they sold a lot of them to Fannie and Freddie. They bought them.
Fannie and Freddie may have bought them, but nobody forced them to do that.
Well, they did it to try to prop the market up, keep the housing market, because they knew that housing prices were being determined by the marginal buyer.
We're here. Notice that we're getting into something that isn't the government twisting somebody's arm to make bad loans.
But Fannie and Freddie was the government, because without the government guarantees, they never could have got away with this. But
you just said, though, that Fannie and Freddie jumped in to buy this stuff because they didn't want to see the housing market go down. Now, last time I checked, jumping in is different from having your arm twisted.
The Community Reinvestment Act is different than the moral hazard of Fannie and Freddie. I mean, these were two gigantic companies that were making huge profits based on the fact that they had a government guarantee, so the market allowed them to borrow enormous amounts of money to prop up housing prices that normally wouldn't have happened. But with the Community Reinvestment Act, I mean, it's clear the intent of Congress was for banks to make loans that, absent that act, they might not have made.
That is not true, nor is that.
Well, then what was the purpose of the act?
The purpose of the act was to push banks to look to see if there were ways to find sound loans to make.
But why wouldn't they do that anyway? If there's a profit incentive, the banks don't need the government to force them to make a good loan. They're going to do that on their own.
It wasn't, taking what you've just said, Peter, literally, you would figure that there are no market failures. And in fact, there's a fair number of market failures. And
So the government was trying to get the banks to do this for their own good because the bankers were too stupid to service this market on their own?
Come on, if you're going to interrupt me, be a little.
Well, I'm
be a
having
little
a
less.
conversation.
Be a little. I'm not object to being interrupted, but it's one thing, you know, where the interruptions are coming at 5 times the rate that mine are. That's a fair point.
Yeah.
But a debate requires an ability for even the southern-born sluggard to get his halting ideas out.
To add a little structure, we should probably actually just have a couple of interruption-free closing statements about what you think the big changes should be to prevent future disaster, in essence. So if you'd give us, in fact, if you give us just like a 1 or 2 minute bullet point list of what you think needs to be different to prevent catastrophe, what should we do?
Okay, so I'm going to start with bank regulation, the area that I have spent a good deal of my professional life on. I would require banks to have significantly higher net worth than regulators have required in the past. And the lodestone for that should be how much capital would be required in a free market with no government guarantees and no expectation of bailouts. And that would be considerably higher than we have now. If you have that, bankers will have a healthier set of incentives for all of their decisions, and the system will become more resilient. In addition, we need to look more broadly at the financial system and look at the interconnections among financial firms. And also at the, so to speak, wiring, the plumbing of the system, and consider is there, and so I'm going to speak in the context of banks, which are regulated. Are we allowing banks to have an unsound and excessive credit exposure to other financial firms? We have a general rule limiting how much a bank can lend any one borrower, but through quirks, regulators have said it doesn't apply to banks lending to each other. And that has provided the rationale for too big to fail treatment, because the proponents of it say, if this bank fails, it'll take everybody else down with it. Well, let's have approved limits, as indeed Congress called for 2 decades ago. Another example of a regulatory change needed would be would involve the money market mutual funds. Right now, money market funds are able to set their share price at $1, even though the actual value of their assets is fluctuating from day to day. I would have the share price for money market funds fluctuate with the value of the fund's assets. If in fact money market funds are investing in the kind of assets they were set up to hold, the fluctuation won't be much, and people will get used to it. So these would be some examples of what I would want to see done. I would not get rid of central banking.
Thanks very much. And Peter Schiff, just in about 2 minutes or so, what would you change?
Well, I mean, I agree with you that banks should be more capitalized. And I think if we had a free market, they would be more capitalized. I think it's the government that protects the banks from market forces, from competition. And so I think that the best way is to get rid of government regulation and to reinstitute market regulations. And it's not that I think that the market never fails. I mean, the market makes mistakes. The difference is I think the government almost always fails. And at least when the market makes a mistake, it corrects it. When the government makes a mistake, it compounds it. And so I think we've got to get rid of things like deposit insurance. I don't think the government should be in the business of insuring bank deposits. If banks want to buy private insurance for their deposits, they can do it. They can market it, they can advertise it. But I want banks to compete with one another over the safety of the institutions, over the prudence of their lending policies, of their balance sheets. I don't want the Federal Reserve, as I said, price fixing interest rates. I want the market to discover the true interest rates so that we have a proper balance in our economy between savings and investment and consumption and borrowing, so that we don't have a distortion, so that land, labor, and capital go to where the market needs them to go, not where the government wants them to go, because that way we don't have a properly balanced economy. So I think we don't necessarily need to abolish the central bank to achieve that ends. I mean, we can rein it in and maybe restore it to its original purpose when it was first created. But I do believe that we would improve our monetary system if we went back to a gold standard. I think we would have, we have much more economic growth when we have sound money and when we take that power away from the government, particularly for middle class, poor people who are really adversely affected by the erosion of the purchasing power of their savings, of their wages, their income, their retirement assets. I think if we have sound money, we'll have more economic growth. We have to learn from the mistakes of the bubbles of the past instead of constantly repeating them. And I do believe that in a free market, profit opportunities will be met. If there's an opportunity to make profits there, banks or any other business, they're not dumb enough to let it go. And if a bank is not making a loan, there's a valid reason for it. And the government shouldn't try to encourage a bank or anybody to make an investment, to do something that absent a government incentive, they would choose not to do, because all that does is create big mistakes that ultimately have to be corrected down the line. Those corrections become very painful, which unfortunately opens up yet another window for the government to come riding to the rescue of what is perceived to be another market failure, but what is really a government failure, and then we just get more government, and the process gets worse and worse.
All right. Thank you very much to everyone who came to hear this. And I just have to say that even though we all learned a great deal, I still think the financial crisis was kind of complicated. Thanks for coming.